Thank you very much for joining. Welcome again, everyone. This is Khushbu Mushtaq. I'll be hosting this webinar alongside my team, and we would like to welcome you all on this special series of IFRS webinars that we are going to conduct it in next few days. So today with me, I have Mr. Osman Babar, our partner of the FAAS department, and Imaduddin, my assistant manager. We are the advisory team of ATH Guideline, and we have been serving for our clients on IFRS for a very long time. And now we are starting a series of IFRS technical expertise, whereby we'll be sharing the basic concepts of IFRS with all of you, and hopefully that will help you all. Okay. So I'll be covering the areas of basic understandings of the standard. Then we'll be having Imad, who will be discussing the areas of CGUs, goodwill, some technical portions. And then we have Usman, who will be helping us out in how can we do the smooth audit and some practical tips that he has been through while his time with PwC. So to start with, what is impairment testing and what are the basics of impairment testing? Okay, so there is a standard in IFRS, International Financial Reporting System. There is a standard with the name of impairment of assets, which we call International Accounting Standard number 36. So this standard is applicable to all the assets that are subject to impairment. It specifies what are the concepts, what are the basics, how the accounting needs to be done, what shall be the reporting requirements. So just to suggest something, that we'll have our Q&A session at the end. So if you can drop your questions in the Q&A section, that will be very helpful. Thank you very much. So let's go back. IAS 36. I'm sure a lot of you must have heard what is IAS 36. The auditors must have been asking you that, do the impairment testing of your assets under IAS 36. So IAS 36 is basically an international accounting standard under IFRS, which suggests the concepts and accounting treatment and methodology, of course, along with disclosure requirement of the impairment of assets. But there are some exceptions. Not all assets are covered under IAS 36. There is an exception of few assets that have their own standards. What are those assets which appear on our balance sheet? Inventories, construction contracts, deferred taxes, financial instruments, any asset that is arising from employee benefits, investment properties, biological assets, deferred acquisition costs, non-current assets classified, held for sale. All these assets have their own specific standards, and all the accounting requirement alongside any impairment, if any, is covered under those standards. We shall be covering all these standards in our future webinar series. Right now, let's focus on other assets apart from these assets on which IAS 36 is applied. So what are those assets? All other assets that are not mentioned in the previous slide. Specifically, property, plant and equipment, which is IAS 16, International Accounting Standards 16. Intangible assets, investment in subsidiaries, investment in associates, investments in joint ventures. So all these standards that you can see in the table, IAS 16, IAS 38, IFRS 10, IAS 28, IFRS 11, the accounting is mentioned for all these standards for all these assets in these standards, but they mention that these assets should be tested for impairment in accordance with IAS 36. So we have to go back to IAS 36 and see how do we do the impairment testing. Let's come to what is impairment. I'm sure most of you already know. we are just trying to figure out the basic concepts, just to recall all those concepts of impairment. So what is impairment testing? Impairment testing is your assets that are appearing on your balance sheet should be carried at a lower of your carrying value or the recoverable amount. These are the two jargons used in the standards: carrying value and recoverable amount. So what is a carrying value? Carrying value is very simple, everyone knows. It's the cost less accumulated depreciation or accumulated amortization. The amount that is appearing in your books of accounts is your carrying value. On the other hand, to do the impairment testing, we have to calculate the recoverable amount. Now let's discuss what is a recoverable amount. So basically, recoverable amount is the fair value of that asset which we can use to sell the asset. So basically your fair value less cost to sell. There's a small formula: fair value less cost to sell. You calculate the fair value, you calculate the cost to sell, deducted from the fair value, you will get fair value less cost to sell. This is one thing of recoverable amount. And on the other hand, for a recoverable amount, there's supposed to be another calculation, which is we call value in use. So there are two aspects of recoverable amount: fair value less cost to sell and value in use. So whichever is higher will become the recoverable amount of that asset. So when we are doing the impairment testing, we need to know what is the carrying value of asset, what is the recoverable amount of asset, and recoverable amount shall be the fair value less cost to sell or the value in use, whichever is higher. But in some conditions, we don't have to calculate the fair value in less cost to sell and the value in use. Why? Because if any of that value is higher than the carrying value, that means that there is no impairment. Both the fair value less cost to sell and the value in use do not always have to be computed. If either of these amount is higher than assets carrying value, that means there is no impairment. So this is the small quick method of doing the impairment testing. What are the timings of impairment testing? It means when do we have to do the impairment test for all the assets that we have discussed initially. So all assets needs to be tested for impairment only when there is an indication of impairment. Basically, there are certain indications specified in the standard that once these indications arise, you have to test your assets for impairment. But there is still an exception. What is that exception? There are three kinds of assets that require annual testing of impairment at least. And the standard says those assets are any intangible with indefinite useful life. There's a requirement in intangible asset standard that some assets are with definite useful life, some assets are indefinite useful life. So let's connect it to that requirement. When your intangible asset is indefinite useful life, only then you will have to test that annually. There's another exception, which is an intangible asset that is not yet available for use. And the third one, which is very important, and I have personally seen it practically on various clients of mine, which is a goodwill acquired in a business combination as per IFRS 3. So whenever you acquire any business as an investment in your books, and during the acquisition, a small amount of or a huge amount of goodwill arises, which appears on your balance sheet as a goodwill. And it stays there forever because there is no depreciation on that. So what do? There's a requirement of IFRS, IAS 36 that goodwill needs to be tested annually for impairment. So these three requirements are fixed. They have to be tested at least annually. All other assets, they will only be tested when there is an indication. Okay, what are indications? So the standard says there are external indicators and there are internal indicators. External, obviously, they are from the market side, they are coming externally. Internal is they are generated internally from the company or the environment. So the standard have specified few examples of external indicators that you have to assess whether if such conditions do arise on your investment, on your asset, let's do an impairment testing for that asset. So what are those external indicators? Any unexpected decline in assets market value, an increase in interest rate affecting the value in use of the asset. Now, this is very important. Globally, you can see that the interest rates are increasing from last year. So this increase of interest rate has already given an indication that an asset's value in use, which we have calculated for the recoverable amount, there's an indication that such value might be impaired. The third condition or the third indicator is changes in technology, market, economic factors, or laws and regulation. This kind of indication is usually arise when the asset is pertaining to technology mostly, whether it is a IP or whether it's a system that is linked to the technology that might be affected whenever, or maybe some medical investment that is done in a medical equipment kind of company, or an asset that is your medical asset. There are changes in technology every other then. So whenever there's a change in technology, there is a condition that, okay, now this asset might not be giving you the cash that you are expecting in future. And the fourth important condition is company's net asset have higher carrying value than its market capitalization. So that happens usually when the asset is an investment and its market value or market capitalization is going down, but the carrying value in our books is already high. That's very clear that this asset needs to be tested for impairment. The first condition, which is the decline in market value, this is also, you can say that we must have seen whenever COVID came. So there was a huge impact on the market values of a lot of investments and assets. Even property, plant and equipment, even machineries, the pricing might have gone low, and the same needs to be tested for impairment. So the COVID was one of the reasons where there was a change in economic factors, political effects and everything. So we have actually assessed and experienced COVID as an external indicator. And my team has actually done a lot of impairment testing for most of our clients during the COVID season. And then let's go to the next section, which is internal indicators. Again, the standard has specified few internal indicators, which are if the asset has been damaged or if it is of no longer in use. Okay, so obviously there are no cash inflows from that asset. Then if there is a reduction in assets expected remaining useful life, or there are plans to discontinue or restructure the operation for the asset which is being used. And the fourth one is the asset's economic performance is worse than expected. So these are general indicators. There might be more depending on the situation that the asset is or an investment is. Another internal indicator which we have experienced again during COVID, there was a huge change in the management of various companies. So when there is the management of that company is changed, definitely that will have an impact on the cash flows generation from those entities. Maybe one of the main salesperson is no more with the company, or maybe the managing director is no more with the company. So that company the fair value of that company is obviously very low, or it will go below than the carrying value most of the time. So if there is an investment in that particular company for any group of companies, that group of company must do an impairment testing for that investment to identify if there is any impairment impact that they need to take when they compare the recoverable amount and the carrying value. So these are the general indicators that standard has given. There are more indicators which we usually see in the practical scenarios that I have already explained. The quick one, there's a quick calculation I wanted to highlight. How do we calculate impairment? So we have done 3 situations. The first one is whereby our recoverable amount is more than our carrying value. So you can see in example 1, the carrying value is 1000. The recoverable amount is higher of value in use and fair value less cost to sell, and it's 1050. So obviously our recoverable amount is higher, so it means there is no impairment. In example 2, carrying value is again 1000. Recoverable amount is higher of fair value less cost to sell and value in use. And over here, our fair value less cost to sell is higher than the value in use. So obviously our recoverable amount will become 980. When we'll compare it with our carrying value, we'll have an impairment of 20. The third example we have given, here our value in use is higher than the fair value less cost to sell. So our recoverable amount will become what is our value in use. Obviously, we have to take the higher of. And when we'll compare it with our carrying amount, there will be an impairment of 40. Now, what do we do with this impairment? We have calculated, we have compared, we have come up with a number. Now, our value is, impairment has given us a value of 20 and 40. Now, what do we do with that? So the standard says this impairment loss is supposed to be recognized immediately in the profit and loss, which means your assets carrying value is required to be reduced and with this impairment loss, so that the value that appears on your balance sheet is not overstated. Okay, so let's take our third example whereby our recoverable amount was the value in use and we got an impairment of 40. What shall be the accounting entry for this? It will go directly in our profit and loss as impairment loss, as an expense or as a loss of impairment loss. Debit 40 and credit will be accumulated impairment loss account on the balance sheet. Let's take an example of property, plant and equipment. We have an asset that has a depreciation as well, and it's appearing as on the balance sheet as cost less depreciation. So what do we do when we have an impairment loss? We'll have to deduct another accumulated impairment loss account from that carrying value. It means that the balance sheet will have the property, plant and equipment net of the accumulated depreciation as well as accumulated impairment loss. As you can see, it's written property, plant and equipment would be presented net of the balance on this account on the face of the statement of financial position. Statement of financial position means your balance sheet. So this is the accounting entry whenever there is a loss of impairment identified. There's another aspect in the standard which is very important, and usually we have seen, not very often, but yes, we have the reversal of impairment. So there are conditions when the impairment loss can be reversed. But it needs to be noted that the impairment loss for goodwill can never be reversed. What's gone is gone. But for other assets, when there is a circumstance that might result in a favorable situation and your impairment loss is reduced, or maybe it's now positive. It means that your recoverable amount is your carrying value might be higher than your recoverable amount or something like that. At that point of time, your impairment loss is supposed to be reversed. Whatever you booked previously, you can reverse it. The standard allows that. On the reversal, the assets carrying amount is increased. Obviously, we booked a reversal in previous example. We booked an impairment loss of 40. And our property, plant and equipment was reduced by 40. Now the standard allows you to increase it by 40, but you cannot increase the carrying amount to the amount that would have been if there was no impairment loss. Okay, so if you have booked an impairment of 40 only, you can only increase it by 40. You cannot increase it by 50 or 60 or forever. So the standards allow you to reverse the impairment loss only to the extent of the loss that you have already been booked. Okay, and similarly, your depreciation and amortization will also be adjusted for future periods. So these are the quick glimpse of whatever the standard says in regards with the basics and the accounting treatments. I would request my colleague Imad to shed light on most important topics, which are cash generating units and goodwill, and then later on recoverable amount. Imad, over to you, please.
Thank you so much, Khushbu. Thank you so much, Khushbu. It was really a nice presentation. I really enjoyed it. Okay, so now let's go a little bit deep into how do we actually do it practically. How do we understand cash generating units, and how do we compute the recovered amounts? First of all, why do we even need a cash generating unit? It's not always possible to calculate the recoverable amount of individual assets. And why is that so? This is because the way recoverable amount has been defined, it cannot be computed always for individual assets. Why? Because some assets might have fair value as cost to sell, but though they still might not have a value in use, because value in use is computed based on the cash flow capacity of the asset. And many assets in a business, in a factory, do not generate cash on their own. They generate it as part of a cash generating unit. So IAS 36 defines a cash generating unit as the smallest identifiable group of assets that generates cash inflows that are largely independent of cash inflows from other assets or groups of assets. Which means these assets have to be generating cash inflows from other assets. The CGU has to be generating cash inflows independent of other assets. So all the assets that are included within a CGU, together they should be generating those cash flows, which means the impairment review need to be done at the level of CGU. So if we cannot identify assets that can be separately impairment tested, we have to make them part of a CGU and do it on the level of CGU. Cash generating units shall be identified consistently from period to period from the same asset. Or types of assets. Excuse me, Khushbu, can you please go to the back previous slide? Thank you. Or types of assets unless a change is justified. So cash generating units, if you have once defined a cash generating unit as a group of assets and you've identified which asset will go into that CGU, in the next year, you cannot change the CGU unless you have a different operations, you have a different plan, or you have a different, or you have a restructuring within your business that justify the reorganization or redefinition of a CGU. So whatever CGU you decide, you have to apply it on a consistent basis. Can we move to the next slide? All right, when to conduct impairment test on CGU basis. So basically, again, when, because the priority is to identify assets for impairment as lower down the hierarchy as possible. So ideally, the recoverable amount should be estimated for individual assets. But if it is not possible, then we have to go onto a CGU. So if the asset's value in use is close to its fair value less cost of disposal, which means its value in use does not need to be computed because it's already equal to its fair value. But if it's not equal to its fair value, and if it has to be computed, then the asset should also be able to generate cash inflows independently from the CGU to be able to compute its recoverable amount. If both of these conditions are not present, then we would say that the asset's recoverable amount cannot be determined, and therefore we have to go to a higher level, to the CGU level, to compute the recoverable amount of the CGU. Can you go to the next slide? All right. So again, to test the impairment, we have to know the carrying value as well as the recoverable amount. So once we have defined a cash generating unit, we also have to first identify which assets are there and what are their carrying value. So it's going to be a grouping of assets. The carrying value of a lot of assets will have to be added, and some of these and the carrying value of some of the assets might even have to be allocated to the cash generating unit. And the assets that serve more than one cash generating units are called corporate assets. Now, in addition to the assets, we cannot also include liability that have already been recognized. Why? Because we have to assess whether the assets are understated or overstated. If the liability has already been recognized in the financial statements, which means its value is already, its negative effect has already been shown in the balance sheet. And if you also include that in the CGU, then it would be a net basis, and that would not be appropriate for the purpose of testing, because you are only concerned about the value of assets when doing impairment tests. Can move to the next slide. Now, allocation of goodwill to a cash generating unit. For the purpose of impairment testing, goodwill acquired in a business combination shall be allocated to each of the acquirer's cash generating unit. Now, for example, if I acquire a business and it has 3 operations, then I would assume that the goodwill that I have because of acquiring that business should be for those 3 operations. Now, if one of that operation shuts down, should I think that and the other 2 operations do well, and if the cash flow is actually more than what it was previously, should I think that the goodwill that I initially acquired is still where it was? Probably not. Why? Because one of the operations that have been acquired is shut off. So probably the goodwill to continue to recognize that goodwill might not be the best idea. So therefore, goodwill cannot be computed on an entity level. It always has to be brought down to the CGUs. Each unit or group of units to which the goodwill is allocated shall represent the lowest level within the entity at which the goodwill is monitored for internal management purposes. So you have to go as down as possible for as much as you do it for the management purposes, and should not be larger than the operating segment. So if you have different segments, they clearly generate cash independently of each other. So there's a limit. You cannot aggregate it more than that. A cash generating unit to which goodwill has been allocated shall be tested for impairment annually. And wherever there is an indication that the unit may be impaired, as we discussed, as Ms. Khushbu told earlier, that we have to test for impairment upon indication, except a few assets. And among those assets was goodwill as well. So once the goodwill has been allocated to a CGU, which means that the recoverable amount of that CGU would also have to be computed annually, and that CGU will have to be tested annually. Can you go to the next slide? All right. Now, let's say we have computed the carrying value of the CGU, and we have computed a recoverable amount of CGU. Now, how do we allocate the impairment loss within a CGU? Because again, CGU was a combination of a lot of assets, right? So when an impairment loss arises in a CGU, the impairment loss is allocated across the assets of the CGU in the following order. First of all, we have to wipe off the goodwill. So let's say if the CGU or the carrying value of the CGU was 100 and the carrying value of the goodwill was 20 and the total amount was 120, and we have impairment loss of 30, then first of all, entire 20 in the goodwill should be wiped off, because that is in addition to our carrying amount of assets. Once we have wiped it off, then the remaining amount should be allocated among the assets in the cash generating unit on a pro rata basis. And that should be in proportion to the carrying amounts already exist, that already exists in the balance sheet. Now, however, the carrying amount of an asset cannot be reduced below the highest of. Now, understand, first of all, it's a very important distinction that just because we are computing the recoverable amount on the CU level does not mean that all the assets in that CGU were unable to compute their own recoverable amounts. Even if they were not, they probably were able to compute at least their fair value less to cost to sell, or at least their value in use, or either of these, right? So if for individual assets in that CGU, we have assets whose fair value or value in use is higher than the amount allocated to them, then that's the floor, that's the limit. So you cannot impair an asset below the higher of its fair value less cost to sell, its value in use, and 0. So you cannot also have a negative asset in your CGU. Can we go to the next slide? Now, measuring the recoverable amount. Measuring the recoverable amount usually boils down to value in use, because fair value less cost to sell is covered under FAAS 13, and it's usually more relevant when we have to sell the asset. And it's usually more likely to be higher than value in use if we are about to sell this asset. Usually, we are keeping those assets in a balance sheet, in a books, in a company, because we're expecting them to generate more value than just by selling it, right? So what exactly is the value in use? The value in use shall be computed by discounting the expected cash flows of the asset. The value in use is calculated in two simple steps. So it's basically value in use computation is like a simple DCF business valuation. We are defining a CGU, and based on that, we are computing its value, just like a simple DCF model. So we have to estimate the future cash inflows and outflows to be derived from the use of the assets and from its ultimate disposal. And you have to apply the appropriate discount rate. So again, we have to project and forecast the cash flows arising from a particular CGU, and we have to discount it based on a reasonable discount rate to come up with a value that would be value in use. Now, as Ms. Khushbu previously mentioned, that because if there is a significant change in interest rates, this discount rate might go significantly up. So if you have an assessment of fair value or assessment of value in use in the previous year, that assessment might not be relevant unless your cash flows have gone up significantly. So because of higher interest rate, the discounted amount might be reduced. So this is a very major external indicator of impairment. All right. So, but we have still specific restrictions as to what kind of cash flows we can include in a value in use computation and what cannot. Because if we are valuing a business, it's a different perspective. We are seeing what a business can generate. But when we are computing value in use, we are saying what the business's assets can do in their current condition. So do not conflate it with the business valuation. First of all, future cash flow should assume the use of existing assets. There should not be additional assets without restructuring the entity that the entity is already not committed to. So you cannot out of the blue say that I'm going to restructure this entire entity and make 30% more profit than the previous year. All of those things might cause difficulty when you are going to an audit, and the auditor might have objections to all those assumptions. Similarly, without incurring additional capex to enhance the capacity of the asset, so you cannot even enhance the capacity of your assets. The only capex that you might require, as we will discuss, might be to sustain the capacity of the asset. Now, what exactly is the permitted capex? Because again, we have to compute the value in use of the existing assets. We do not have to assume significant increase in assets or significant increase in capacity. So first of all, any cash flows are to assume the current condition of the asset. You cannot assume a better condition if their productivity is maximum. If their maximum capacity is 80% of their ideal capacity, then you have to assume that. And again, you cannot assume everything out of the blue. If the market conditions say that you would only be able to sell 60% of your capacity, then you will have to limit your assumptions to that. If the cash flow results from a cash generating unit with some having shorter useful life than the other, those assets may be assumed to be replaced. So for example, if there are 10 assets in your CGU and 3 of them have a useful life of 2.5 years, then you can assume to replace it 4 times because that is required for the continuation of the CGU. So that way, the CGU might continue on a rolling basis. Similarly, if an asset contains parts that have shorter useful life than others, capex on their replacement can be assumed. So some assets have parts that are significantly more valuable, and they are separately recognized as assets sometimes, and they are depreciated at a different pattern. So if the capex is done to change or enhance those parts to maintain its sustainability, to sustain the current condition of the asset, then that capex can also be included in the value in use computation. Can we go to the next slide? All right. Cash flows for value in use. Disposal cash inflows. Cash inflows from disposal of asset after its intended use shall also be included in the estimate. Now, we do not only have to compute we do not have to only include the cash flows from selling the produce of the asset. We also have to include the cash flows from the disposal of those assets. And basically, that value, the estimate of the cash flow should be closer to its fair value. Because how it's defined, it says it should be the disposal of an asset at the end of its useful life that the entity expects to obtain from disposal of the asset in an arm's length transaction between knowledgeable willing parties after deducting the estimated cost of disposal. So basically, this definition is very close to the definition of fair value less cost to sell. And this is exactly why, if an asset is just planned to be sold very soon and it's not expected to be used, then its value in use would also equal its fair value less cost to sell. Other cash flows. Moreover, the following cash flows shall not be included on the value in use computation. Now, cash inflows or outflows from financing activities. So if you are adding some financing activities to your CGU, if you're investing in your CGU, or if you're obtaining a loan, or if you're repaying a loan, all those cash flows are not relevant to the computation of the capacity of the asset, to the value of the asset. They are independent of the assets and they are separately recognized in the financial statements. So again, those cash flows do not serve the purpose of computing the value in use. Income tax receipts or payments, again, these are outside the scope of the value of the asset, so therefore they also do not have to be accounted for. They do not have to be incorporated in the value in use model. Can we go ahead? Finally, the forecasts, again, because IAS 36 doesn't want us to go too aggressive on the forecast. It has certain set criteria, set requirements that might tame down the management's expectation of what's going to happen in the future. First of all, the IAS 36 does not permit forecasts of more than 5 years to be used unless the entity can demonstrate that it can measure it reliably. For some business, it might be really predictable. For example, an entity might have a very binding contract for a particular set of assets, and it might be predictable. It might be able to predict what the cash flow would be for the next 10 years, but that would be rare. Normally, it would be limited to 5 years. After 5 years, a steady or declining growth rate should be assumed, like we use in the business valuation. We use a terminal growth rate. If there have been variances between management's past budgets and actual results, they should be appropriately accounted for when assessing forecasts for its reasonableness and achievability. Now, IAS 36 does recommend that the management's budget should be used, but again, it reminds us if the management has been using the practice of ideal budgeting, if it's been over budgeting, over expecting its revenue income, then we should look into the past variances and see whether those budgets are realistic and whether those expectations are fit for the purpose of impairment testing as to what the management actually expects to achieve in the future. Similarly, if the budgets assume significant increase in capacity, then they are not relevant for the purpose of impairment testing projections. And we just discussed, for example, because there is a limitation of what kind of cash flows to be used within the value use computation. So if management budgets includes an expansion in the future, that does not mean that the current assets also have that additional value. So any value in use computation should not include any budgeting assumptions that include a plan to expand in the future. The discount rates. The discount rate shall be pre-tax rates that reflect current market assessment of the time value of money and the risk specific to the asset for which the future cash flow estimates have not been adjusted. This is very important because sometimes whenever we make a model, a DCF model, may it be a simple business valuation model or may it be a value use model, we can either take certain risks inside the cash flow projections or we can incorporate those risks in the discount rate. For example, if I'm already making a pessimistic assumption of this might go wrong and that might go wrong, that's why my sales growth might not go more than 5% or 3%, then I have already incorporated those risks within my cash flow projections. In that case, I do not need to have an excessively high discount rate. I can lower down the risk premium on those on the discount rate. Can we go further? Again, this is an overall picture of what should we incorporate in a value in use model. What kind of risk and what kind of factors should be included. First of all, an estimate of the future cash flow the entity expects to derive from the asset. This is the projection. This is what we have been discussing so far. The kind of cash flow projection we have to make and how we have to use management budget and what kind of restrictions are there on the cash flow. So all those assessments, all of those calculations should go back to making this cash flow forecast. Expectations about possible variations in the amount of time in those future cash flows. Now, if you expect variations in those cash flows, they might be in terms of scenario analysis. We can incorporate those as different scenarios and give different weighted probability to those scenarios, or we can adjust those estimates inside the discount rate. The time value of money represented by the current market risk of interest, as we discussed, is a significant factor, especially in the current market condition. As the discount rate is increasing, we really need to understand. We really need to reassess our values. This is a very significant indicator of impairment. The price for bearing the uncertainty inherent in the assets. This is the normal market risk premium that we include in our valuations. Other factors such as illiquidity, the market participants would reflect in pricing the future cash flow. This is the risk premium to incorporate the entity specific or CGU specific risks. Again, it must be highlighted that it's important not to double count the risk and uncertainty. For example, in the last 5 factors have been incorporated. If these factors have been incorporated in the discount rate, care must be taken to not include them also in the future cash flows. You either incorporate the risk, certain risk in the cash flows, or you incorporate them in the discount rate. Can we go further? Now, I would request Mr. Usman Babar to please share his insights on some practical aspects of impairment testing and how clients can work towards a smoother audit. They can prepare in advance. They can conduct the exercise in a way that they might have. It might be easier for them to convince the audit and get through it smoothly.
Thank you, Ahmad. And thank you, Khushbu. Thank you so much for a very informative and wonderfully conducted session so far. And really excited to share some of my experience. One thing that straight away comes to my mind is a couple of years ago, once we were all kind of facing the COVID situation, that was a big indicator of impairment. And that triggered all businesses. I was looking after a big developer at that point in time. But irrespective of industry segment, it triggered all managers, all finance managers, CFOs, many of whom are guests today, to kind of look at their balance sheets and assess their businesses, their CGUs, their assets for impairment. We've kind of moved out of that. But again, with the rising interest rates that we've all kind of witnessed over the last 12 months, what the US Fed, almost every quarter, the way the interest rates have been going up, is also a very strong indicator and is going to be the reason many of the big 4 audit firms and other auditors, they will be looking at the CGUs at the businesses and questioning, the management about impairment. So all the people who are sitting on the other side of the table need to kind of plan for that. They need to be prepared for that, because easily the interest rates have gone up by 4-5% in the UAE year on year. That's itself a very strong trigger. Now, keep that in mind, justify the discount rates from a practical tips perspective. If you're using the same discount rate you were using last year, it's going to be questioned in light of what's happened in the last 12 months with the interest markets, interest rates, apologies. Also, where you need to be consistent is how you always viewed your cash generating units. So if certain assets were clubbed in one and certain assets, the logic behind that, the reasoning behind that, there should be some consistency. Often, I've also seen managers come up with some unrealistic, the finance managers, they come up with models which have very unrealistic growth rates built into it. So that's an area where people have to be very careful and justify why they're expecting the growth rates. And lastly, when it comes to capital expenditure, see, the purpose of IAS 36 is to understand, when we're doing the value in use calculations, it is to understand, okay, what is the inherent recoverability of this CGU or asset. So we have to also kind of not look at, consider capital expenditure to enhance the business performance, but we have to ensure that there is enough capital expenditure built in to maintain the cash flows for the business. And like last Imad said in his towards the tail end of his section, that we have to be very careful not to double count impacts in the discount rate as well as in cash flow. So avoid the double counting, because that could be challenged. And yeah, with that, if we've considered these factors, if there's any impairment, then like Khushbu said, that needs to be recorded, or if there is a reversal, then we've already discussed how that will be considered as well. Back to Khushbu.
Thank you so much, Usman. Thank you, Imad. Wonderful presentation. I hope we were able to transfer some of the basic knowledge and revive the information that we used to study back in time to all our participants. Thank you everyone for joining. I think we can just take 5 more minutes to take some questions that we have. Okay, so we'll be taking few questions one by one. Okay, the first question I can see, if an asset is recently revalued, do we still need to do the test for impairment? Imad, would you like to take this?
Yeah, sure. So basically, if an asset has been revalued, it has been revalued based on the fair value standard, and the fair value less cost to sell also uses almost that standard, except there is a cost to sell included inside the IAS 36 assumptions. So if it's expected that the cost of disposal are going to be material, then it might have to be impaired to the extent of the amount of cost of disposal. Otherwise, it does not need to be impaired. If we have a very recent estimate and we do not have any further indication of impairment, then it really usually does not need to be impaired again.
Thank you. I think this is what we have seen in during COVID times, that year-end valuation was done, and soon the COVID arose. Things changed, and there were huge indicators of impairment for those assets who were recently revalued. So I think that's okay. There's another question. What is the difference between recoverable amount and fair value? I think we have already answered it initially, that recoverable amount is the higher of fair value and fair value less cost to sell, or the value in use. There's another question. Will you be sharing the slide deck copy? Yes, Faizan, we'll be uploading it on our YouTube page of our company, and you can see it over there. It's athguideline.com. We have a YouTube page. We'll be uploading soon after the webinar, so you can see the slide over there. Then we have Mr. Muhammad Sami. What is the meaning of market capitalization? Market capitalization is the share price into the fair value of that share. It's a multiplier effect of share price into the price of that share. It becomes the market share, number of shares into the share price. It becomes the market capitalization of that company. Okay, how do you practically assess the indicator that intangible has declined, and by what value? For intangible, Mr. Faisal has asked this question. Mr. Faisal, honestly, we have seen some indicators for intangible, as I told you, other than goodwill. There are intangibles that should be tested for impairment that we have for a software company. I have done it myself. The company got a competitor, and the value of its software was declined. So since that was an intangible and there was a competitor, we had to do an impairment testing to analyze what is the impact of impairment the company needs to book. And you have asked by what value. Value, I think we have already explained that we have to do the entire value in use calculation and then come up with the figure that by what value it needs to be reduced. Okay, this is, I don't know if okay. In circumstances where fair value less cost to sell is not possible, what is the way to calculate recoverable amount other than calculating value in use? Imad, would you be able to take this? He's asking that.
Of course, yeah. So basically, these are the only two ways. If both of these cannot be determined, the recoverable amount cannot be determined on the asset level, then we'll have to go on to the CGU level.
Okay, there's another question regarding if the company is having continuous losses, will it be considered as an internal indicator? Yes. On the other hand, if startup having losses in the starting years, should we consider this as an indication? Okay, now this is a very
I would like to clarify a little bit. Just don't conflate indication with impairment. Indication is not does not always mean that impairment has occurred. Indication is just a hint that possibly we might not be able to recover from our assets what we have currently booked in the value that we have booked in our balance sheet. So we have to recheck whether our assets are worth less than that. So may it be a startup or may it be a running company. If it's constantly making losses, then there's a high risk that there might be an impairment. So it is a very strong indication of that.
Thank you, Imad. Then all questions are related to calculation. Which percentage we should use for calculating value in use to discount it? I think we have already answered it, Mr. Hasib, that it has to be the discount rate. Mostly that what we recommend, it should be WACC, weighted average cost of capital. But if WACC is not used, I've seen people don't use WACC. They only use their discount rate, but it is recommended that you should calculate the WACC of that particular asset and then do the discounting to bring it to present value.
Yeah, so basically any discounting cannot be in the air. Whenever you are discounting something, you have to always relate it with what the market is, how the market is behaving, and how the market is pricing risks and equity in the long run. So a WACC is the perfect way of discounting any value in use calculations, because we have for the risk-free rate, and then we have the premium for investing in the risk, and that premium includes the market risk as well as the entity specific risk. So that's the best way to break it up, to be very clear about what we are doing in our value in use calculations.
Okay, then accumulated impairment loss is a liability or an equity? It is not an equity, it's just the same account like we have for depreciation. It's accumulated impairment is a liability account that is net off from the cost of
I like to call it a negative asset. So it's basically because on the balance sheet, the amount is going on the net basis. So impairment can be seen as a negative asset.
Okay, I have a question from Hasib. Hasib, it's not clear then how to calculate depreciation on principal value, or we need to revise asset value. I'm not able to understand this question, Hasib. Would you drop us an email on this ID so that we can assist you properly? Then Mr. Shakil, kindly give an example of impairment of goodwill. As I just told you that we have seen various entities who recognize goodwill under business combination, but due to some indicators, the business is not doing well, and the auditors mostly ask them to assess the impairment of goodwill, because people don't do it regularly, but it should be for as mentioned in IAS 36. So yes, we calculate the fair value, the recoverable amount of the goodwill, and then compare it with the carrying value, and then record the impairment, if any, in the books of the parent company. Then Mr. Sami is asking, impairment loss or charge or reversal would not impact the cost of that asset. Of course, it will not. Please share the material. Yeah, it will be uploaded on our YouTube. There's one question from Hashir. Is the raw material in manufacturing industry subject to impairment testing? Raw material is purchased earlier at a higher price, whereas market prices are lower now. It will be converted into finished good later.
Yeah, so basically, as Mr. Kushbu told in the start of the presentation, that inventories are out of the scope of IAS 36. So if you are impairing your inventories, you have to go to IAS 2. IAS 36 is not applicable in on inventories. It's applicable on property, plant, equipment, and intangibles and goodwill.
Thank you, Imad. Okay, just two more questions that we'll take. How do you deal with a situation where one has identified on CGU, but management have not produced projection and cash flows relating to that individual CGU?
So basically, you are saying it from the point of view of the auditor. The auditor does not have the responsibility to prepare those numbers. Basically, it's the responsibility of the management. So what would you do if the management does not prepare the financial statements? Obviously, we'll ask the management to prepare those. But obviously, management can ask other entities, other servicing firms to help them in the process, and we also provide these services.
Okay. Thank you very much. I think we'll take one. Okay, Syed Amir is asking, you talk about goodwill allocation to CGI. Why goodwill is monitored at a lower possible level? Please explain again. Syed Amir, if you can drop your question in detail at our email ID, Imad will be able to justify and give you a proper answer for that. I think we have taken most of the questions. We'll try to share the YouTube link with all the participants who have attended this session today. Thank you very much. I think we are crossing the time. Thank you, Usman. Thank you, Imad, and thank you all the participants to be with us. Hope to see you soon, inshallah. Thank you very much.
Thank you, everyone. Thank you, Khushbu. Thank you, Mr. Usman.
Thank you all. Thank you, Khushbu, and thank you, Imad.